Welcome, everybody, to this installment of our YouTube series. Today, we wanted to talk about a topic that George and I have been talking about a decent amount on Twitter, which is the risk-free curve and the yield curve, and whether those two things are the same and how they relate to the economy.
Yeah, I think it's important to really understand the reason for stressing the yield curve and its importance, so as one can develop a macroeconomic view. It is also the main reason that we can figure out as to why everyone has been perhaps more so than I can remember in the last several decades, absolutely lockstep wrong in terms of expectations for the U.S. economy, how it will evolve, and what people thought where we would be now versus last year or 2 years ago. And this isn't just Twitter Space or even the analyst at J.P. Morgan, although actually it was J.P. Morgan's Jamie Dimon who started the ball rolling in January of 2022, as he started to talk down his own earnings for J.P. Morgan to the best he could. He's limited because he's a bank. There's only so far he can go in terms of managing earnings, but he gave it a good go, and he pretty well called a recession to happen by the end of 2022. Now, we think, and I think most macroeconomics economists would agree with this, even ones who are only taking a cursory look at the U.S. economy would say that the U.S. yield curve is the most important economic input to develop an opinion. Without an understanding of the current yield curve and how it has evolved, you can't have a useful macroeconomic understanding. It provides the current pricing of NGDP growth. The yield curve, our yield, is not there because of demand supply of treasuries. We'll get into that another date, or just Fed policy or what have you. The yield curve is formed because it's the understanding of how the NGDP level and growth will will develop over the next time as the schedule for the yield curve. It provides market expectations for future NGDP growth. A good way to look at the term premium, which you've probably heard about, which is how much yield is required to get someone to extend their duration in U.S. Treasuries or any security, is really the accelerant of NGDP growth. If the risk premium is very high, then it indicates that the expectations are for NGDP growth to grow briskly for the next several years. If term premium ever gets flat to negative, then it indicates that people are anticipating a recession, or a recession has actually happened. Therefore, it ends up being the core understanding for almost all macroeconomic forecasts. And then such that the NGDP level and growth is important for any risky assets in the United States, it can be said that the yield curve and understanding the yield curve is the basis for all asset forecasting and analysis for like the S&P 500, new homes, any risky asset. Now, we know now a reality to the U.S. economy that you just can't debate it. That the economy was, and here we use personal consumption expenditure because we get a pretty good, accurate monthly report on PCE from the Bureau of Economic Analysis, while GDP takes place every quarter and is somewhat lagged and subject to revisions. But personal consumption expenditure is a fairly robust, stable series, and it gives us information on the here and now and how we've recently developed. And before COVID, personal consumption expenditure. This is all the buying in malls and food and wine and what have you, all the household expenditures, uh, was just was sort of stepped back a bit, but because of the COVID fiscal measures, it stabilized and it went up to about 15 trillion before the end of 21. And since then, it just rocketed ahead. We've done a lot of work on the fiscal impulses and the monetary impulses, and where we think a lot of the initial first couple of years growth came from. But now with a fairly startling, approaching 17 trillion in personal consumption expenditure, this also means that since the majority of the money has been spent and distributed for the fiscal COVID emergency response, as well as whatever the Fed could do or can't do, that's sort of been done. So it's very likely, if not even, it is what's happening, is that 22, we've had a transition from this emergency fiscal stimulus to a standard Keynesian pump priming, where the economy is given the setting that was established by this fiscal setting, has just charging ahead. Now, why I bring this up is that it is almost impossible for the yield curve to have been inverted or negative at any point. Let's say it transmits into the expectations of the U.S. economy 2 quarters, 3 quarters. Well, that means that it just could not be had been inverted any time, say, before mid 22 or so. And yet everyone just blithely carries on, and it's getting very strange where many people, because of their understanding of the yield curve, are claiming that this isn't happening, that where the PCE and the economy has actually already gone into a slowdown, only you're not seeing it the right way. They have the magic sauce, the secret sauce to figure that out. So your yield curve that you're looking for and working with has to calibrate to this. It cannot be otherwise. And yes, there's a couple quarters lag, but the usual time spent for this lag is only a quarter even, or possibly 2 quarters. So to say that the yield curve, the U.S. Treasury yield curve, is forecasting a recession or a slowdown means that you're saying that this thing is going to turn tail and just come off really, really hard, which is a very unusual. It probably can't happen given the amount of fiscal stimulus that's gone into the system and the employment and other variables. But nonetheless, the New York Federal Reserve probably is ground zero for a lot of this understanding of an inverted yield curve. Therefore, they take a pretty decent model, which worked like a charm up to 2020, which is relating the yield curve into what will come about in terms of the U.S. economy. So all these stands with the probability of recession, like say in 1980, and then again for the Reagan recession in 81, 82. A little bit in the 90s and at the end of .com and so on. They happen. I mean, this probability actually, was not quite a tautology, but because it's based on the regression of various algos, it did result in a recession. So the term spread, 10-year versus 3-month bill, this dips. Is very good. I mean, it's really worth your while to pay close attention to this, which of course everyone has done so. Sometimes these it tends to 2, sometimes tends to 1, and so on. And this inversion of the U.S. Treasury yield curve sent this model and most other macroeconomists who are dependent upon a yield curve understanding into a near certainty of a recession or slowdown happening. But That, of course, does not jive with this at all. It's a head scratcher at best. And in fact, we can say that the New York Fed, and bold words because it's just packed full of PhDs and the best and the brightest, yield curve model is wrong. And everyone who is using this yield curve model wrong, or similar type of understanding, also is wrong. They're just out to lunch. So that means that this is a very strange phenomena where the vast majority of the forecast, the macroeconomic understanding of the United States, is wrong. I don't think it's ever happened before.
Right. So George, just on that point, so is it fair to say that up until about 2022, the New York Fed yield curve model was mostly fine, and then the fiscal impulse is the thing that like doesn't get accounted for? Is that how you'd characterize it?
I would say that, but I think actually what it is that I'm just gonna erase the yield curve and say it doesn't exist. So and yes, there's reasons why the economy will carry on, and there's reasons why the yield curve should be of a different shape, of which fiscal and the monetary is perhaps it certainly was the most important from 2020 to maybe the end of 23, mid 23. But the bigger reason for this, and we're still trying to sort it out, is that the risk-free rate is supposedly the U.S. Treasury 10-year rate. None of this makes, if you're using U.S. Treasuries, and if they're not the risk-free rate, they're not going to do what you expect them to do. They are not going to answer the question in terms of what the probabilities of recession or slowdown are ahead. And for many years, and this goes back to probably a decade or so prior to this, day in, day out, quarter to quarter, year in, year out, the risk-free rate was the U.S. Treasury rate. That means that but for some sector segmentation, maybe some games, the odd gaps here and there, you could just simply use the U.S. Treasury 10-year less whatever you wanted to use, 2 years, 3 months, like the New York Fed does, and that would be the risk-free curve. This all changed, and I think this is it happened rather recently in the second, third quarter of 2022, and it changed with a big move. And what we do is that the inversion that is this blue line here, of where U.S. Treasury 10 years have traded along with the 2-year. We look at the 2-year. We think that if you go to the 3-month bill, it gets too busy and too immediate in terms of games that the Fed's up to at that time. But if you look at the 2-year, yeah, there's zero. It's really it plunged, going into 21, 22. It fell off the cliff, and it was very reasonable based upon all the prior understandings that this meant that there's going to be a very significant recession, if not a slowdown ahead. But that's if you use the U.S. Treasury 10-year. What we note is that the U.S. mortgage rate here, we have the 30-year index and for mortgages. We also modify it a bit by the conventional mortgages, which all go into I think almost all of them. I don't think any banks hang on to them anymore. It just goes right into the MBS machine to make mortgage-backed securities for Fannie Mae, Freddie Mac, and the other GSEs. The mortgage rate, which has to respond to the actual reality of the economy, it has to be something to do with this, because people are out there buying and selling houses and being able to borrow money and so on. It also influences the supply of new homes, existing homes, and so on. So this mortgage rate has to be planted in the reality of the U.S. economy. It can't be modified at all by the Fed or anybody, because if they try to lower this mortgage rate, just havoc would happen in the home markets and new homes and so on. On the other hand, they can't be punitive. They can't tighten or anything by raising that mortgage rate, because also hell would be, you just have hell on earth with the confusion, the chaos. So this rate is solidly plugged into the economy. And then by its channel that it goes into the mortgage-backed securities, which are risk-free, that is the limit in terms of what they can pay or borrow at, is with that risk-free end game for them in the mortgage-backed securities. This therefore has always had a very constant spread to U.S. Treasury 10 years until 2022. And then this broke out, which is this green line here. This seems like a small amount, but it's actually very, very large, because what it does is it changes the yield curve, which is the input for all these models, from a negative to still solidly positive. There's been a lot of things happening. There has been some tightening of some sort, some concerns, some risk aversion where the yield curve is flattened a bit, but this is nowhere near a possible recession or a slowdown in the U.S. economy. So by looking at the wrong yield curve, or not looking at the yield curve, I guess is a better way to put it, I would say a phenomenal amount of just taking it as a given that the U.S. Treasury yield curve is the actual risk-free yield curve for the United States, have been blindsided. I can't remember I can't remember another time this has happened, and I don't remember any time in reading prior that this has happened. This is really extraordinary, and it's well out by it's put about 90% of the macroeconomists, the folks you hear on X/Twitter, it's put them offside. They're wrong. They're just wrong. And if you look at it this way, and if you accept the idea that we have identified the correct risk-free curve, then it's very hard to dispute that the economy is not charging ahead at a very fast clip. Maybe it will slow down, but it'll be slowing down from a very high level of 27 trillion or so for NGDP. And this just throws like everyone on their head. There's a person who seems very sincere and very able and very knowledgeable, Anna Wong, who's the chief economist for Bloomberg. I think they're going to have to like duct tape her to her office chair and wheel her out because she is not giving up. She's just using this as the truth, when it just has nothing to do with the U.S. economics right now.
So on that point, what would your kind of diagnosis be for why the two curves in the chart before this chart, the 10-year yield and then the mortgage implied 10-year yield, why they diverged in 2022? Do you think it's like the legacy of QE and like the Fed's yield curve management? Is it these people being just like way too bearish, market making a mistake? Because the relationship between the lines is very, very solid until 2022, and then they broke apart.
Yeah, I think that's a very important question right now, and I can't say I've come up with the answer. I know where to look at. It's just like, well, what's changed now versus where it was before? Mm-hmm. QE and then QT. The QE in terms of the COVID emergency QE, which was just like a crazy drop to ZIRP, and then raising rates right up to 540. Not realizing that 540 is just but a normalization level. It's not a level that means anything. And then something was triggered. So something was triggered in 2022 that sort of blew everything apart. And there was a drive, perhaps by the Fed itself, rate setting. Yeah, maybe the Fed is conducting a sort of a secret, lower rates as needs type of thing, despite what it did happen around Silicon Valley, and as concerns start to build for the banking system, some are a small part of the banking system. I don't know, Riddick, have you got some ideas on this?
I think if I had to explain it again, like this is mostly just a little bit of guesswork, but I think since the financial crisis in 2008, 2009, there's been the Fed has been locked into this kind of paradigm of like zero interest rates, forward guidance, et cetera. And I think that's like weighing down on even the long end where people just believe that the Fed will eventually just like bring the economy back to ZERP and like try to like quote unquote ease and stimulate the economy through that means. Um, but I think the reality is exactly what you're saying, which is that the normalization of rates to 5% isn't some sort of tighten. It's just getting rates back in line with like what the economy is already doing. So one thing I actually wanted to touch on that then is, so the yield curve here, the red line, clearly not inverted. There's still some steepness. Does that imply anything about where we might think the Fed funds rate is going? Because right now, at least going into 2024, basically, if you look at like the forward path of policy, there was, 6, 7 cuts priced in for 2024, and very little chance or expected chance of a rate hike. But over the last month or so, about month and a half, those pricing cuts have slowly gotten priced out. The long end has risen. Now only 3 or 4 cuts are priced in for 2024. Do you think that this curve, the sort of real risk-free curve, that implies that the Fed may actually hike or may cut less than what's priced in?
I I think it probably, there's got to be somebody in the Fed looking at this. I would hope so.
Yeah,
Uh, and I don't think they think they're out of the rough parts of inflation yet.
right.
I think they're very wary. I think they're also very concerned that the Fed funds aren't having the response that they wanted.
Exactly.
Powell said as much a couple of times now. So they're hesitant. So they are probably looking at this, or at least intuitively understanding something similar to this, so that the likelihood of the Fed funds rates being, dramatically cut are probably slim. I think where this might be more important is what it means for the growth of NGDP and sustainability of inflation.
Yeah.
If inflation were to drop more, I would think this would be more approaching zero. But since there's a fair amount of curve here, it probably means that inflation's bottomed, and we might actually see inflation go back up, although not in as dramatic a fashion as before.
Right.
Putting that together, it's very strange, because this inversion, which this represents, is perhaps the I don't know, 110%, certainly 100%. I don't know, okay, maybe 90% of why people have a bearish view on the S&P 500
Yeah.
and other risky assets in the United States. Now, this is what we've also come as somewhat of a sidecar to what we just went over, but there's still all sorts of commotion about the size of U.S. Treasury financing, which is because of the deficit, which is causing the great growth, is somehow going to impact term premium, which is the increase in yield per, i.e. the curve, increase in yield per year. And here we have the term premium. And Riddick, you just lifted this from a well-known, from the Fed, or which model?
This is the ACM 10-year term premium I just found on Fred. Haven't done anything
Okay,
to it. Yeah.
so it could be a little bit more, it could be less, but it's certainly
Yeah.
not zero. And
Yeah.
I think we can go with it. And then this blue line is the change of debt that's coming into the market year over year. There's no relationship. Okay, this sort of dips down once out of 20 odd years. This, I guess, is a smoothing, but this is that you're just in all sorts of ridiculous pointing your fingers all over the place to try to
Yep.
figure that there's a fit here.
Yep.
There isn't a fit. They have nothing to do with each other.
I think that's one of the beauties of taking the mortgage implied rate, is that now we're able to get a rate that reflects the economy, that reflects NGDP, and doesn't like reflect what people think is like supply or issuance or like duration issuance. I think, yeah, that's one of our key points of the monetary frontier, is that the real risk-free curves reflect how the economy is doing, and no amount of like finagling by the Treasury can really affect that. It's ultimately just how the economy is functioning.
Right, and when you use the word real, you don't mean
True.
nominal.
No, yeah,
You're talking about like the reality
yeah,
curve.
reality. True, I guess is what I would
I get a little,
say.
I shudder a little bit every time
Yeah.
you use real, but okay.
Okay. The true
I think,
risk-free curve, I
okay,
think, is better.
the true risk-free curve. Okay,
Yeah.
true detective.
Yeah.
Um,
And I think one thing else I wanted to ask, could you go back to the chart with the three lines? Um, yeah, this one. So I guess one question I would have, and I've asked this in the past too, is basically like, okay, so in 2022, the blue line, the green line got disconnected. The 10-year yield is too low relative to what we think the true risk-free rate is. What's to say that, that that disconnect continues? What's to say that that disconnect could even widen in the future? We think the Treasury yield will hit 6% this year. We'll have to go up, reflecting that strong economy. What's to say that the market continues to get it wrong and yields go lower from here?
I think there's a good chance that people carry on. There's just too much an investment in their algos and the political structure within a firm for becoming head of the economic department, and so on. So this might have some momentum to it. The also thing is that this is a huge difference, and if you look at other points where it did differ, it very quickly corrected down, like within months. And that was during points of great distress, like the GFC, even the dot-com day. That didn't really rattle this relationship. Nor was this relationship even if you take it right back, you might find some moves in early 80s in the Reagan recession, but it quickly returns. And then also it's somewhat mean reverting in terms of like some sort of common rate for both the US Treasury 10 years and also the risk rates. But this is different. This is not just maybe here it looks like they're trying to close, but boom, out it goes, and it's being maintained out there.
Yeah, makes sense. Is there anything else you want to hit in this video?
No, I think that's good. We are going to dust off some of the old bond mechanics, fine curves, whatever, to try to come up with another. We want to fit this curve with the green line, which is the basically mortgages less an assumed spread to U.S. Treasuries, and fix it with a more maybe academically sound idea of what the curve is, with the idea of not forcing it to fit this green line, but finding if we can find it, what is this curve saying to us in terms of various inputs into the expectations, such that it fits with this.
Right.
And then if we get that figured out, we should have an early warning system that is not just our investment in terms of we have to be right because we know this is right, and it's I just got the job as head of the economics department and I got to maintain it. And I think we might have a jump on everyone else in terms of like when this turns.
Right. Makes sense. Yeah, this I think was really useful.
Okay. All right, Rick. Thanks a lot for hosting this, and I hope this is of use to you guys. Please subscribe to the Monetary Frontier and follow Riddick at RPGOYAL_ and myself at Bickering Brattle. We are open to any criticisms. Just don't insult us. I don't have time for that. I can do that to myself. But we're open to any criticisms, ideas, discussions. We're set for consulting, wherever you think we could be of use. Thank you very much.
Great. Until next time. Thanks, guys.